up ahead. Affirmative 612.
This week on the Wealthy Pilots podcast, we got a couple of comments and listener feedback on 401ks and I guess, maybe some do's and don'ts or, myths, things of that nature, maybe dispel some conversation pieces. So, Scott, I thought we would tackle that and talk about that just a little bit this week. How you doing, my friend?
Great. How about you?
Doing pretty good. I'm also excited to report that Scott has a new chair. So we will stop the squeaking here pretty soon. I think he can get it built before the new year.
Yeah. Hopefully before the new year. So I know we've gotten a couple messages about the squeakiness. So we're going to get it fixed here.
We're going to get it fixed along with the 401k conversation. So let's talk about it, right? Let's talk about how it just in general, but also how it affects like your client base as well.
Yeah, perfect. So, the 401k, it is not a really long race that we run, right? It's compared to a 5k. But
do you remember that? Did you ever see that Will Ferrell movie? I forget which one it is, but they go to borrow money because they're losing their house or they got to send their kid to college or whatever. And he's like, yeah, we've got all that money in my retirement account. And he's like, sir, you've got like $17,000 in there. He goes, no, I've got $401,000 in it. And he's like, no, that's called a 401k.
It's called a 401k. Oh, shoot. Yeah, that's not the balance, unfortunately. So
Right.
But yeah, so the 401k, most folks know like, hey, it's a retirement plan. It's offered through work. I mean, that's like, pretty common knowledge, but I mean, where does the number even come from? I mean, it's literally the IRS code 401k. That's right. And so we abbreviate to a 401k plan. And it's a plan that is provided to employees by their employer. And so, where some of the confusion comes in is really around the different kinds of, I'll say, sub accounts within the 401k, and then how the tax treatment is made, or how the tax treatment of our dollars going in and coming out of those plans is handled. So there's that aspect to it. And then there's also, the nuances of employee contributions versus employer contributions. And then we have max contribution limits from the employer, from the employee, from all sources. And then we have catch-up contributions for different age limits. And so I thought we would just take a little time today to talk about, just some of the mechanics of the 401k. So the first part is really looking at, I wanted to talk first about the tax classification. So we're not going to get into like performance of 401ks, investment options, anything like that. I mean, that stuff obviously is very important, but we're going to keep that out of the scope of today's conversation. So the first thing I want to talk about is like each 401k, and not all companies have this, but definitely most of the major airlines have it.
Okay.
And candidly, most larger companies have this structure. But you will have 3 different types of accounts inside of that 401k plan. You'll have a pre-tax, you'll have an after-tax, and you'll have a Roth. Okay. Each one of those accounts has the same limits to it from contribution. I mean, from the higher limit of what can go in from all sources, what you can put in, what the employer can put in, et cetera. I'll talk here in a minute about some of the constraints that most of the airlines have on where their contribution's going versus where yours is going. But let's talk first about the tax treatment of the dollars of each bucket. Okay. The first bucket, the default bucket, the bucket most people are familiar with when they think 401k, this is what they think of. It is the pre-tax or traditional or tax deferred 401k account. Okay. It's one of those 3 phrases is typically how it's identified: traditional, pre-tax, or tax deferred. Okay. Mm-hmm. The dollars going into that bucket are reducing our taxable income for that year and going in, how we say pre-tax. It's going into the account pre-tax. Those dollars have not been taxed, and it's reducing your taxable income by whatever you put in. Okay. If the airline is putting the money in, that's not, I guess that technically that's still reducing your taxable income compared to it going into your paycheck, but most of the large airlines are doing an auto contribution. They're not doing a match. They're automatically putting in 8, 10, 17, 18% based on the airline you're at. That's going into the pre-tax account. So it comes in, no taxes paid on it. it stays in there tax deferred. So when we rebalance that account, there's no capital gains, there's no taxes on the dividends, there's no taxable anything with that account, typically for years, decades, typically for decades. You know, if I start at one airline at 25 and I retire at 65 for 4 decades, you're not going to have typically any taxable transactions that happen inside of that pre-tax, tax-deferred traditional 401k.
Right, which is everybody knows you're waiting on that tax bomb to hit because the government wants their cut.
That's right. That's right. Now, when we retire, every dollar we take out of that is taxed at whatever our current ordinary income tax rate is. Okay, so when I retire, based off of what state I live in, I might have higher taxes. Tax rates might go up, whatever the case is. Whatever tax rates are, if you looked at, you know, if I'm going to retire in 10 years, I look at tax brackets for 2035 on Google, and it's going to show you what the marginal tax rates are, and whatever my income sources are going to put me in a certain bracket, whatever distributions I'm taking out. So if I'm in the 30% bracket, for every $10 I take out, 3 is going to go to Uncle Sam. All right. And so what's nice about that, especially for some of the higher earners, it reduces their taxable income. Okay. The downside is you're just delaying, you're kicking the can, you're delaying the inevitable. And so, you know, many times it can be prudent to diversify outside of having all of our investment money in that one bucket, so to speak, because if I have all of it in that pre-tax bucket, it's nice. It's deferred taxes for me. At the same token, I'm inheriting in my financial plan an increased amount of tax rate risk, meaning if tax rates go up, which tax rates are near historic lows, national debt is an explosion beyond long-term highs, with no sign of changing anytime soon. So the younger you are, I would say the more likely it is that tax rates could be higher in retirement for you. And also the more time you have for growing, you know, non-pre-tax money in these other 2 buckets.
Well, and that leads to an often myth with things is people think, well, I'm going to be in a lower tax rate when I retire. I've heard that forever and a day. So even if I am kicking that can down the road that you're talking about, Scott, it won't be as painful because I'll be in a lower tax bracket. And that's just often not the case.
That's correct. And again, this is where I would say, like, I'm not making a blanket, recommendation to go to one, sub account or the other. You want to just look at your plan. If you're a higher earning pilot or higher earning executive, it might make sense to keep it all in that pre-tax bucket. But if you're younger and you're, in some of those mid to lower brackets, it might make a lot of sense to get it over in the Roth, which I'll talk about the Roth here in a second. But I just wanted to make sure pre-tax reduces our taxable income, gets funded with pre-tax dollars, grows tax deferred. And then when we take the money out in retirement, it's taxed at ordinary income rate, whatever that is at that time in our life.
Yep.
Second bucket, not used very often at all, but most plans do have it available, would be the after tax bucket. Okay. After tax, not Roth. So common misconception here, after tax bucket, after tax 401k account is funded with after tax dollars. So it does not reduce my taxable income. I pay the tax on the income. The after tax dollars goes into the account. And then the money grows tax deferred. Okay. So I'm not paying taxes on any rebalancing. I'm not paying taxes on any dividends, whatever the case is. But when I pull the money out, I have to pay income tax on the gains. Okay. Mm-hmm. So if I put in $1 million and then it's worth 2 million, that gain, I'm going to have taxes on that gain when I pull it out of the account. Okay. So we call that the money that we put in, we call the cost basis. And so whatever the gain is on top of the basis, we owe tax on it. If for some reason you have a loss in there, you don't have any taxes on the loss. So again, not one used quite as frequently because it's a little bit of a middle ground. But it kind of leads us into, but it is an option in many of the plans. So it's like, hey, it's worth knowing what it is.
People might be familiar with like the backdoor Roth conversation. So this is kind of where some of that leads to, there's a different way of looking at that.
Yeah. And so, the backdoor Roth is where we will, and it is somewhat similar, but it's where we're eventually going to get it in this third account, this third sub account
Correct.
called the Roth 401k. Now that Roth 401k, we have after-tax dollars. So we pay, it's basically like we get paid, we pay the income tax on our dollars, and then it gets put into the Roth 401k sub account.
Well, and they made that, Scott. That's newer. That's like 2006. I want to say they started doing the Roth. Not every company does it yet. More and more are coming on board, and it's kind of a nice hybrid because there are income limitations with doing the regular Roth, and that's one of the things that got kind of removed with the Roth 401k.
Correct. So if you were wanting to do like a standard Roth IRA contribution, first of all, the limit's like $7,000 to put in. So it's not a ton.
Right.
Second of all, there's income limits for that most of our pilots and executives are above. And then, the third point is to basically what you were saying is there's no income limit for the Roth 401k. So it is a great way to get that tax-free money built in. But again, we put pre-tax money in, it grows tax-free. And here's the beauty. When we pull it out of the Roth, it's also tax-free.
Right.
And then the fourth benefit, when we pass it on to a beneficiary like our spouse or our kids, it's also tax-free. And then they get to distribute it tax-free.
At least that's the rules for now.
Correct. And candidly, I would be super shocked to see them mess with this Roth stuff. I mean, not that many people have tons and tons of money. There's many other issues, I think, for them to address from a tax law standpoint to raise revenue. Sure. So yeah. I would be surprised if because that's basically like going back on a well-established tax code item. So I'd be super shocked if they mess with the Roth stuff. However, there's a lot of power in the Roth, right? I mean, it's especially if you're making good money right now and you can kind of afford to pay the tax, so to speak. You're paying the tax now, and then that burden's behind you. And you could look back in retirement and say, "Oh man, I was in a higher tax bracket in my working years than I am now. It was not smart to put it in Roth. I should have put it in pre-tax." So that is something that could happen. However, what I can tell you from working with many, many, many retirees, nobody I've ever talked to one time has regretted how much money they've had in Roth. I've never had somebody sit across the table from me and say, "I wish I would have deferred more taxes back then to have more in tax deferred because I ran the numbers and I would have paid less in income taxes." Well, they don't even really think about that.
That's a great point, though.
Yeah.
Because running the numbers is going to make a big difference. Because we hear people all say all the time, well, if you're younger, definitely do the Roth, right? Definitely do the Roth 401k. If you're older, maybe not, right? Maybe doing a regular 401k might still be a better way to go, or doing a traditional IRA. So it's all about your specific numbers too, and seeing where you're at because of tax, because of lowering your taxable income and or growing the money tax free. Depends on what you specifically need.
Yes, absolutely. So that kind of leads me to, that's the tax classification of each of the three. Pre-tax, traditional, 401k or tax deferred. We have pre-tax money go in, gross tax deferred, taxable as ordinary income when it comes out. After tax bucket, after tax money goes in, only the gains are taxable when we pull it out. And then Roth, after tax money goes in, gross tax free, distributes tax free to our beneficiaries. Now, one might say, "Hey, why don't I put all the money in the Roth? I'm willing to pay the taxes now." Most of the airlines will do their automatic contribution or company match contributions into the pre-tax account. You don't have a choice. Into the pre-tax account. Okay. I'll hear some, especially some of our higher earners will say like, "Hey, I don't even put my money into the 401k because the company automatic contribution hits the max every year, which is like $70,500."
Okay.
And so the airline's putting a good amount in especially for some of our higher earners. But sometimes I might push back a little bit and say, "Hey, maybe it makes sense for us to put a little bit in the Roth, right? Because they can put $23,500 into the Roth, and it does increase their taxable income to get that 23.5 in there, but it enables them to get some diversification of what account those dollars in and the tax classification of them. And again, if they're putting 23.5 in the Roth and compounding that every single year, that's going to be a really nice account when you retire. And so then you run into, okay, well, what am I going to do with the money that spills over from what the company contribution is? Based off of your airline, they might have some sort of market-based plan that it goes into, or we open up a separate account at Schwab or Fidelity and you invest the funds there, either way. But I just want people to know that it's worth looking at saying, hey, instead of just taking what the company gives me and that's it, should we lean into doing a little tax planning and diversifying where our saving is and setting ourselves up? So like one of our key deliverables we're always working on is trying to get you to show up at retirement and say, man, I'm glad I did that, instead of, man, I wish I would have. And so, it's worth sometimes to just take a step back, look at the tax classification of the dollars, do some, shifting of our direction setting, and then re-engage. So there's that part of it. And again, it can be a little tricky when you get on the website and all that kind of stuff for some folks, because it's not something they're looking at routinely. And so when we're sitting down with people, we're going like page by page on the website to get all this stuff set up correctly. So that's a little bit of the implementation support that we're doing, because it can be a little tricky with checking boxes the wrong way and all that. So last thing I want to hit here, and then we can kind of wrap, Mark, would just be kind of summarizing, I think, some of the important things to remember from a contribution standpoint. So again, the max from all sources is like 70,500 this year. Okay. It changes every year. And so again, for some of our higher earners, the company is going to be able to max all that out just through their automatic contribution. But if you're over the age of 50, you do want to look at, the catch-up contributions. That's something that you want to make sure you're taking advantage of. And then it's weird how they do it. If you're 60 to 63, we have a super catch-up contribution. If you're over 63, it's just back to the regular catch-up for those last 2 years that they're flying.
Yeah.
But again, we have the employer contribution. That's going to go to pre-tax. So that's kind of is what it is. Not much we can do but if we want to engage in employee contributions, we have the base for everybody is 23,500. The 7,500 is for those 50 and over that they can put that in. And then when you turn 60, you can increase that to an additional 11,250. Okay. So again, even if you're a higher earner and maybe you're like, hey, I don't care, I'll just pay the tax because I want to get more Roth money. I mean, you can be getting in your 23,500 plus your 11,250. So 34,750 into the Roth the last few years of your career. So you can get it to add up pretty quick.
Yeah. That's not chump change.
Yeah, exactly. So anyways, all that to say, I wanted to take at least, revisit this topic. We're getting into a season where a lot of folks are hiring before the holidays and all that. And then, we probably need to share this one once a year, every year in January. So maybe we'll talk about that, because it's just a good refresher on looking at my plan, looking at my income, looking at my retirement roadmap, and then figuring out where do I want to save in these different accounts and understanding what the tax implications are going to be of that. Because again, you're going to show up at retirement at 65. You're going to start looking at these assets to live off of, and you're going to reap what you sowed one way or another at that time. And we want you to look back and feel happy with what you reaped.
Yeah, absolutely. Yeah, what you reaped and what you sowed. Exactly.
Yeah.
So if you got some questions, need some help, as always, reach out to Scott. I mean, again, every situation is going to be slightly different. These are universal things that obviously affect us all, just like a lot of stuff in retirement strategies and conversations. But how you dig in and how you apply it to your specific situation does change from person to person. And that's what the conversation and the strategy sessions are all about. So one thing you can do is you can just jump on and order the retirement toolkit. Molly's going to come on and tell you how to do that. Or you can just reach out to Scott right now and get started at retireairlines.com. That's retireairlines.com. And don't forget to hit subscribe on the Apple, Spotify, and of course here on YouTube platforms. That way you catch new stuff when they come out. Scott, thanks for hanging out and breaking it down. I'll see you next week.
See ya.
We'll catch you next time here on the Wealthy Pilots Podcast. Stay tuned to get your retirement toolkit. We'll see you next time.
Hey everyone, real quick, if you haven't grabbed Scott's Financial Flight Control Toolkit yet, now is the time. This is packed with tons of helpful resources and tools like this, Scott's book, The Dichotomy of Wealth, which is a pilot's guide to maximizing wealth, and cash flow in retirement. You also get access to some great guides like this one, Advice Matters, which breaks down 4 key ways a good financial advisor can help you boost your returns over time. And guides like this one on the pitfalls of emotions when it comes to investing, and this one on the HCM byline investment strategy, and more. So if you'd like your very own financial flight control toolkit, just click the link in today's show description, and Scott and the team will be happy to get one sent your way at absolutely no cost to you.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.